Welcome to this event today. My name is Chris Sleet. I'm the H.J. Heinz Professor of Economics at the Tepper School of Business. Thank you for joining us for the W.L. Mellon Speaker Series Coffee Chat with Tepper alumnus Charlie Evans. For those of you less familiar with this event, this is an annual series that's designed to give our students an opportunity to hear from global leaders, CEOs, and management experts in forums that encourage insightful dialogue. We're glad you're joining us today. Our format will be a moderated coffee chat. However, we will allow time at the end for audience Q&A. Please type your questions into the chat box, and my colleague Ariel Zetlin-Jones, who will manage the Q&A part of our session today, will draw from submissions during that portion of today's program. Before we jump into the program, I'd like to acknowledge the Tepper School's partners for President Evans' talk: the Undergraduate Economics Program at Carnegie Mellon, the Tepper Alpha Asset Management Club, the Institute for Politics and Strategy, the Center for International Relations and Politics, the Alexander Hamilton Society, and the Dietrich College, which is celebrating its 50th anniversary this year. Charles L. Evans is President and CEO of the Federal Reserve Bank of Chicago. The Federal Reserve Bank of Chicago is one of 12 regional Federal Reserve banks across the country. These 12 banks, along with the Board of Governors in Washington, D.C., make up our nation's central bank, the Federal Reserve System. As President of the Federal Reserve Bank of Chicago, Charlie Evans serves on the Federal Open Markets Committee, the FOMC, the key decision-making component of the Federal Reserve System, and oversees roughly 1,400 employees who conduct economic research and supervise major financial institutions. His research examining the effects of monetary policy has been published in leading peer-reviewed journals, and he's also taught at the University of Chicago, the University of Michigan, and the University of South Carolina. Additionally, Charlie Evans is very active in civic initiatives, holding positions on several councils such as the Chicago Council on Global Affairs and the Rush University Medical Center, as well as being a member of boards such as the Civic Committee of the Commercial Club of Chicago. Charlie Evans received a BA in economics from the University of Virginia and a PhD in economics from Carnegie Mellon University, right here. President Evans, we're honored that you're joining us here today.
Great. I thought I'd just give a few opening remarks about the economy and the influence of the pandemic on the economy. Let me say at the outset, since I am a member of the Federal Reserve, these are my own remarks. They're not attributable to anybody else in the Federal Reserve System or any of my colleagues on the Federal Open Market Committee. The pandemic and economic crises we face today are unprecedented. It's important to speak candidly about this national emergency and the almost unimaginable human losses we could experience from the pandemic in the United States and around the globe. Our hearts go out to those who have been stricken, and we can't express enough gratitude to healthcare providers, first responders, and others who are providing care to save lives and protect families and delivering essential services. They are truly heroes. On the economic front, we clearly are looking at very large losses in employment and national output. This is a simple fact. In response to enormous public policy efforts are underway to support households, businesses, and financial market functioning. Notably, the CARES Act provides for large additions to state unemployment insurance payments, a small business administration lending program that includes strong incentives for businesses to maintain employment, cash payments to the majority of U.S. households, and assistance to adversely impacted firms in leisure, travel, and other industries. In order to support the much needed flow of credit to households and businesses during these difficult times, the Federal Reserve has injected massive liquidity into the financial system, reinstituted many of the programs we used during the 2008 crisis, and added new programs in conjunction with support from the Treasury. I also want to acknowledge the substantial efforts by the private sector, from industrial efforts to transform auto manufacturing into the production of ventilators, to businesses keeping workers on the payrolls even when business activities have been shut down, and to debt forbearance by creditors. Many volunteers and organizations are stepping up to help keep our country safe during the pandemic. Our discussions with contacts throughout the Federal Reserve System, that is our Chicago Fed 7th District, have described many heartwarming personal stories. There was the warehousing company that donated unleased space to FEMA, a commercial real estate firm we spoke with, helping its tenants navigate SBA programs, and a childcare provider taking in neighbors' kids for free so that that neighbor could head off to her essential medical job. All of these actions seek to convert the sudden and deep economic downturn that is currently underway into a relatively short-lived recession. With substantial financial support, households have the chance to meet expenses while sheltered at home. Many businesses should be able to meet their obligations, and the health situation allowing, the economy can begin to recover in the second half of 2020. But there are many caveats in this hopeful storyline, and many things must go right in order to minimize the economic pain. The medical community has clearly warned us all that the resumption of more normal levels of business and consumer activity will be dictated not by economics, but by the widespread containment of the virus and the public's confidence that they can safely return to more normal social and commercial activities. The economic downturn will be deep. There's no getting away from that. But the biggest risk that it will be deep and prolonged comes from the possibility of a more severe pandemic experience that delays an economic recovery in the second half of 2020 or even in the first half of 2021. This risk may be with us for a while. I have no expertise nor any role in designing public health policies, but we can be most assured of a sustained strong economic recovery when a vaccine is widely available so that workers, consumers, and businesses can safely and confidently go about their job of putting the economy back on its best footing. That could be sometime down the road. The United States has already committed trillions of dollars in welcome federal fiscal packages in relief support to the public. But even more action would be valuable. Funding a Manhattan Project-like joint effort of US and global experts to accelerate the development of a life-saving vaccine could have huge returns. There are reports that Dr. Fauci is leading massive attempts to accelerate the development of a vaccine, and I've seen news reports that Bill Gates is supporting the establishment of 7 separate candidate vaccine initiatives with separate manufacturing production site developments. This recognizes that any single initiative is risky and its production will likely need to be customized to make it at scale. In the meantime, my conversations with healthcare leaders here in Chicago makes it clear that a national plan to distribute scarce personal protective equipment and ventilator resources to the regions that are in the most need is crucial for reducing the loss of life from the current surge. Furthermore, risks from potential second and third waves of coronavirus outbreaks must be reduced. A national plan that included greatly expanded testing along with contact tracing could help reduce the risk of future outbreaks altogether. This would clearly increase the odds of a quicker and stronger recovery. With our nation's best efforts, the virus will be contained soon and a vaccine will become available before long. But if we've been successful in keeping businesses in place and keeping their relationships with employees, suppliers, and customers intact, then hopefully the U.S. economy more quickly will get back up and running. But it is important to be candid about the future. Even under a best case scenario, the U.S. and global economy will be less prosperous coming out of this crisis than we were going into it. As we hunker down and stay at home, we are all using valuable resources and savings that we had intended to use for other aspirations. Households, businesses, and our government have been on the front lines battling the economic consequences of these critical public safety measures. And it seems likely that additional resources will be required to navigate through the next several months and beyond. These resources are being very well spent. They're the key to maintaining economic relationships while we seek to contain the virus. Still, put simply, beyond the unimaginable human losses from this pandemic, no one should imagine that they are financially immune from this crisis. We have a lot ahead of us, but it's important to remember that we entered this crisis with solid economic fundamentals. We have a good base to build on. Our future economic success may well require initiatives and national collaborations that we have rarely imagined and not in recent times. Working together, households, communities, and businesses, in combination with strong government action, will get us through this crisis. Thanks very much for letting me make those opening remarks. And Chris, I look forward to an engaging question and answer period with you and everyone else.
Well, thank you very much. Let me start by saying you became president in 2007, and just as we were entering another crisis. How does this crisis differ? How does it feel different to you? Perhaps you could elaborate on that.
Yeah, that's a great question. Yeah, I did not expect to go through another crisis of any similar proportion to that one during my tenure. It's really quite remarkable and unfortunate, obviously. I think the earlier crisis was one of financial distress. There was a lot of excess leverage, and it's referred to as a great financial crisis, and the unemployment rate went to 10%. And we had to deal with the fact that aggregate demand was extremely weak, and there was a debt overhang, and there was a very slow recovery coming out of that. Current situation is really very different. It's really a real shock. It's something having to do with a virus that no one has immunity to. It's extremely infectious, and so as we go about our normal working arrangements, we're at risk of contracting this virus, and it has very serious implications. Don't know what the mortality rate is, but it's much higher than the normal flu. And since nobody has any immunity to it, the proper response seems to be to shelter at home, basically stay away from contact with others, and that means shutting down the economy. So what's different about this one is the solution seems to be shutting down the economy for some period of time, hopefully very brief, while the virus spread is reduced, God willing, eradicated, but that's a strong call until we get a vaccine or more testing and contact tracing and things like that. But if staying at home for 3 months, closing down businesses for 3 months could get us into the third quarter, and then if we could start the economy up, if all the business relationships stayed intact, if the employment relationships, which are extraordinarily valuable, if all of a sudden people could just come back to work, you can imagine it's a rebooting the economy, and what the losses are the resources expended to keep people safe for the 3 months while they were at home. It would be a temporary phenomenon, and then we could go back and have a growth period. We would have lost those resources that were expended, previous savings, and that's the part about we're not going to be as prosperous initially going forward until we grow and invent more things for that. But there's this hopeful possibility that this is a temporary downturn, very sharp. Unemployment rates of 20% are forecasted by many people. It's just the numbers are unimaginable. In terms of the second quarter growth reduction, you see people forecasting 20, 25, even 40% annualized growth rates. But because we're expecting to rebound, I don't really think that number captures what we're really facing, because we should see increases, on the rebound side. But so much of it comes down to respecting the virus spread, making sure that we're safe. We can actually reopen businesses. If we try to reopen businesses too soon, and then we have another wave of that, then it's going to be more prolonged. Then it's going to be much more of a prolonged downturn, and that would be very, very costly. So getting it right early on is critical. It's not really a monetary phenomenon, but we have been called upon to provide resources to keep market functioning proceeding as best they can.
So that's very interesting. So I've seen our current circumstances described as a global pandemic with local characteristics. And the 7th district, your district, there's Chicago, there's rural Iowa, Wisconsin. So within that district, there's a great deal of heterogeneity. How is that? And the Federal Reserve banks are charged with overseeing monetary affairs within their districts. How's that shaping, the Fed's thinking in Chicago, that heterogeneity that we see?
Yeah, so I oversee, our Federal Reserve District is 5 states, and so it's the larger parts of Illinois, Indiana, Michigan, Wisconsin, and Iowa. So there's definitely the agricultural element, rural element. There's also manufacturing. We've got the auto sector to the east of our district. We've got heavy equipment manufacturers on the western side of that, Caterpillar, Deere, making mining equipment and tractors and things like that. There's a lot of commerce. I mean, in terms of what we're facing at the moment, the virus spread doesn't respect any borders. Anyone in a high density area obviously is at greater risk of virus spread if you're not hunkering down at home in isolation. And so before anybody realized it, I think with the travel that comes into Chicago, international airports, but Detroit has been hit extremely hard by this. And they've had their hospitals are on the point of being overwhelmed. Mortality rates are really very high, and we're finding out that vulnerable populations, people who don't have the same access to health care, people in vulnerable health conditions are most at risk here. And so a lot of what we do is monitoring, because this isn't really monetary policy, but we're trying to figure out where are business conditions affected. And I worry a lot that there's complacency in areas where the virus is yet to emerge, but is likely to be lurking underneath. I find it remarkable that the fourth largest per capita outbreak of the virus was in Albany, Georgia, a relatively small municipality in southern Georgia. And it's because somebody shows up and then all of a sudden it spreads before people realize that. So I think one of the nice things about having 12 reserve banks spread throughout the country is we have our ear to the ground. We're talking to businesses, trying to find out how they're dealing with this. And, where the big downturns are, obviously restaurants, leisure, hospitality, who's, sort of still going about commerce. If you can work at home like we are, there is that opportunity. So the technology allows us to keep going in many, many ways, but it certainly has changed the patterns of commerce. Certainly, people have learned more about online grocery shopping than it was available before, but it's really being used fully now.
So let me ask then, and this was touched on a little bit in your opening remarks. There are businesses that are facing liquidity problems, perhaps very temporary liquidity problems. There are businesses that perhaps were marginal businesses before. Their business models were struggling even prior to this, and this may finish them. How does the Fed distinguish between illiquidity and insolvency, between when it attempts to provide liquidity to businesses at this time?
Yeah, this is a fascinating topic. It's one that emerges during any crisis, certainly financial crisis. When is it that the firm, a financial institution, moves from previously having an adequate amount of capital, given the risks that they thought that they were facing, given the lending that they may have been undertaking, or the loans that they had taken out, and then all of a sudden something happens and their business model breaks down. And when is it that they're insolvent and not able to go forward? When is it that they're just illiquid, that their future prospects still look good, but because they don't have cash on hand, they can't make their payments, but whoever comes along afterwards is able to keep the business going because the prospects are really good. The current situation is that and much, much more. I think what we're finding there. So the economic fundamentals for the economy were really quite good going into this. Unemployment was very low. There were a lot of small businesses. Small businesses, by their very nature, are a little more month to month in terms of cash flow. How much of a cash buffer do they have to survive this? Not nearly as much. That doesn't necessarily I mean, they're somewhat fragile against a big shock, but they're really important for continuing commerce and keeping people employed and things like that. They create a lot of jobs. They destroy a lot of jobs, but they create a lot of jobs. And so the fact that there is that fragility against a very big and unusual shock like this one means that it's very costly for the economy. I mean, then if you think about the state of commercial real estate, I mean, anybody driving around, looking at strip malls are harder to, fill up with retail establishments because of the change in technology, digital technology. And so if you're a lender who's managed to fill up your commercial real estate with these small businesses, and then all of a sudden you find they might not be able to ride out 3 months, but if they could get through 3 months, they might still be good. Wow, you'd really want to think about helping them out, or at least that judgment about that, because who's going to come along after them? There's a lot of choices like that. And I certainly hope that businesses, creditors are, working through this. We're only going to really survive to the second half of this year if everybody sort of understands that, loss is going to be taken by, pretty much everybody. It's really not reasonable to expect that you're going to make it through this without losses. And so some amount of forbearance so that everybody is better off in the future is going to be an important part of that. So the solvency, liquidity is an important issue, but a lot of this right now is let's get everybody, to the second half of this year and then think about what the future looks like from there.
So going back to the financial crisis of 2008-9 for a moment, that changed things. That changed the regulatory environment for financial institutions. How do you think this crisis will change things? Do you think we'll return fairly directly to these strong fundamentals you were describing, or do you think there will be more permanent changes to the way people consume, the way people interact and do business?
Probably all of those things are in play. I think that after the 2008 financial crisis, I think that the Dodd-Frank reforms banks going into this crisis are better capitalized than they were going into the 2008 crisis. They have more and better capital, and so I think that's good. They have more liquidity. That's also come at some cost because they've had to have a certain type of liquidity. They've worried about being caught short against that regulatory buffer, and so perhaps they took less risk against that. In a micro-prudential world, you like that. In a large macro-prudential world where you need everybody doing more credit intermediation, it cuts against that. And so the fact that we're hit by a widespread national shock affecting everybody that is completely real, there's just no way you could have insured against this. That is a role for the government to sort of socialize more of these losses so that we don't fight it out as much in order to, who's going to take these losses and who's going to end up on the short side. And that's going to determine what the society and capitalism looks like going forward. There's a role for government to clarify that so that the rules of the game can pick back up with everybody in a better state of play once we get to that, past this crisis. But it is going to be, it's going to be a lot of transformation. And certainly the digital technology has, shown its importance. It's really helped out amazingly. I mean, imagine if we had a shock like this 20 years ago when we didn't have this. We'd be doing conference calls a lot. And I still do conference calls because bandwidth is an issue. And why is bandwidth so expensive in the US and a little cheap in other places? There's a whole bunch of issues, but there's going to be a lot of transformation.
Let me just perhaps step away from the crisis for a minute. We just have a few minutes before we go to the general Q&A. So we're at CMU, we're very much a technology-oriented university. There's a lot of interest in blockchain here. There are both amongst technologists and also amongst economists and business oriented people. So are there particular technological innovations in financial markets, be it in blockchain, the use of machine learning or otherwise, that the Fed views as particularly promising or is monitoring carefully, is thinking about?
Yeah, so the Fed is really quite interested in the state of digital technology, what everybody's doing, machine learning, AI, in ways that so many businesses are, right, because that is going to be the future. Employing the digital resources in the most productive fashion. It's going to determine where the next terrific products are produced, competed on, and all of that, where productivity is going to come from. Um, it's interesting, from a, economic background, looking at some of the technologies that are, brought to bear on what machine learning is. Some look, really kind of terrific, gee whiz. Others look a little more pedestrian, sort of data mining types of things that go under a different terminology that make it seem more 21st century than what it was 10 years ago. And so I think that whoever is really able to harness that in new and unique ways is really going to lead the path forward. So I think that's very interesting. From a central bank perspective, one thing that is of great interest, I would say, certainly digital currencies. People have talked about whether or not a central bank should have a digital currency, and some foreign central banks have definitely moved further to think about how they might implement that. I would say in the Federal Reserve, we are studying that. We're certainly mindful of what everyone else is thinking about. Um, I'm not exactly sold on it myself, but having said that, I do think that it's very important that the Federal Reserve study this and have a viewpoint on what the best path forward is. The nature of the payment system in the United States is still somewhat archaic. I mean, we provide financial services, among the Federal Reserve banks. We do that. We compete with the private sector, commercial banks, and in making payments. And, it's always surprising to note that there are still people who use paper checks, very archaic, although very safe. There's a bunch of different types of transactions that I undertake with my own depository institution where I make a credit card payment. And sometimes it makes that credit card payment electronically. And other times it chooses to send a paper draft to the credit card company. And why do they do that? It has to do with different safety provisions and the size of that transaction. I think that getting on top of that and providing the safest, most secure digital payment system, a real-time payment system. The Fed is embarking on such a system. The clearinghouse provides a system of sorts at the moment, and I think competition in that realm is a good thing. And so I think that's very important. But we very quickly think that technology is everything and everywhere, and in fact, there's still a lot of evolution that is required. That's exciting, but there's also a lot of work that needs to be done.
Okay. Just one last question before I go over to Ariel and the Q&A part. We've got many great students here at Carnegie Mellon. We in our undergraduate program, through our master's program, through our PhD program, in economics, business, and other fields. For students who are interested in a career in the Federal Reserve System, in the board, in a regional bank, do you have any advice for them?
Oh, absolutely. I mean, the Federal Reserve is an active employer of, people with wide-ranging skills, people who are interested in economics, people who are interested in technology, all kinds of things. I personally found the Federal Reserve to be, a very good institution to work for. I started out my career, I studied at Carnegie Mellon, and I think like most people who get a PhD, I anticipated a career as a university professor. One way or another, I kind of found that being at a reserve bank allowed me to continue to do research that was very important to me, but also to do policy analysis and get involved in that. And the public service aspect of that is really very appealing to a large number of people. I think that's one way that we attract a lot of people. We have to be competitive in in an income wage setting. We are, but it's also the case that the public service proposition is very attractive for a large number of people. So people with analytic skills, anybody interested in machine learning, AI, technology, we offer opportunities there. We're heavily involved in the payment system, and we're rolling out a real-time gross settlement system over the next couple of years to compete so that everybody can, get away from, untoward bank fees and be able to make payments on time and cheaper. So there's a lot of interesting areas for people to work. And people come and they work sometimes, like myself. They thought they were only going to work for 3 to 5 years. Some people do leave after 5 years. Other people find themselves working for 30 years. Anybody can work and have a variety of experiences. It's a terrific place to work.
Now I'm going to turn over to my colleague, Ariel Zetlin-Jones, and he's going to handle the Q&A section of our program today. Ariel, are you there?
Yes, great. Thank you, President Evans and Chris, for those thoughtful remarks and interesting discussion. I'm going to try to piece together a few of these questions. Our audience has given us a lot of interesting questions to think about. So, unsurprisingly, in response to the large stimulus the Fed is enacting, there are concerns on both sides about causing a large inflation after the recovery, or perhaps we're entering a deflationary spiral like Japan did in its lost decade. How do we think about those trade-offs? And in particular, if we think our economy could look very different after the crisis than it did before, as employers and people learn what it means to work from home or not, does the Fed have to rethink its model for how to deal with inflation going forward?
Well, I think given given the circumstances and given the downturn, given the way that the work environment is changed currently with the stay-at-home work remotely environment, if you can, and then getting back, I think we're going to be challenged in terms of assessing the safetiness of the environment. If a vaccine is developed, if we have widespread testing, then we ought to have a level of safety. But we also ought to be mindful of the fact that different mutations of this could come along. I think these are risks that we need to be paying attention to. Now, we have used large, shocking amounts of resources to smooth the downturn and avoid a recession. The legislation, they passed trillions of dollars of relief. That's going to become national debt. So the debt is going to be higher. And I think that's entirely appropriate given that this has hit everyone in the United States. Everybody is at risk. And I think socializing those losses is a function of government. But after we get past this, then we're going to see what type of economy we have. What's the how are we going to be producing things? Is technology going to be different? Are people going to prefer different types of goods and services? And then as that comes about, what's the state of economic demand relative to the resources that we have? Is it going to put pressure on prices? Are we going to see prices going up a lot? You mentioned, with debt and debt financing, prices could go up. We've been really challenged to produce inflation in line with what our 2% objectives have been. We've been underrunning that. And an environment of a prolonged downturn is one where I would expect inflationary pressures to be low. So I think first thing that you do is you get the economy going, you get everybody in the best place that they can be. The entire world is dealing with this. We're not going to be facing a situation that others around the world aren't facing. And we're all going to have to figure out how to make this work together. That's part of the, I said in my opening remarks, I think we're going to have to figure out how to work together in ways we haven't contemplated, anytime recently, if ever, and just try to find our way through it. But I'm not really worried about inflation. We've got, other things that are much more important at the moment. And I don't think it's going to, if anything, I'm going to worry that it's going to be too low.
There was also a question about the line between fiscal and monetary policy. And given people have such heterogeneous access to the financial system and the rescue effort the federal government's trying to create, do you view there being a growing role for the Fed in providing access to this type of financial relief you've been describing?
So it's interesting. During the 2008 crisis, Chairman Bernanke, Fed rolled out a variety of liquidity support programs to help financial market functioning, which was unbelievably important. The TARP funding provided a capital cushion so that the Fed could engage in a variety of financial support, which had credit risk to us, and we're not supposed to undertake credit risk. As the Monetary Authority, the Federal Reserve Act says that we're supposed to be employing safe, assets, and we shouldn't be taking on credit risk. But with the 13.3 authority, with the collaboration with the Treasury Department and the administration in 2008 and now, we have legislative capital funding that the Treasury has provided, and they can take the first loss. And so we can, start working on Main Street funding. We can do corporate credit programs. We can roll out the TALF, asset-backed lending facility. Again, we're doing the commercial paper funding facility. Some of these have more credit risk than others. The pricing is structured so that it's not supposed to be a gift to anybody. If anything, it's supposed to be priced at a little ungenerous during a normal market period, but probably a pretty good rate during a period of stress. And that's what helps the economy through that period. The other thing about these facilities, so they're done in conjunction with the Treasury. And so it is a central bank working with the Treasury. I think it's completely appropriate in the current environment. What they're doing is providing this first loss cushion for us, and we're helping put these programs together. These programs are largely self-liquidating, and so they only are going to be around for some period of time. There's a structured length of time for them, sometimes a year, sometimes 4-year maturity on some of the assets. But it's also the case that firms and borrowers can decide they don't need this anymore. And when they don't need that anymore, that's when the economy is doing better. And that's another aspect of the self-liquidating. And so our balance sheet, which is really quite large now, will go down in part because of that self-liquidating nature of a variety of these programs.
We have a wide number of questions, it seems, on moral hazard. Can you talk about your views, perhaps, on whether now is a time to be concerned about moral hazard of bailing out financial and non-financial institutions, or if not, or do you think there are other aspects of moral hazard provided by the response to this crisis that you are worried about?
I think traditionally in financial markets, what's worried me most in a moral hazard standpoint would be something like a too big to fail policy, where financial institutions, could be anybody, but somebody is offered extraordinarily generous borrowing conditions that do not properly take into account the risks that they are facing, and the risk pricing is too low because the investors just sense that the Fed is going to swoop in and make things fine when things go against them, but they get all of the upside. And so that's really the moral hazard problem. I would say that a period in the run-up to the 2008 financial crisis was one where, risk pricing was inadequate, whether it was just complacency or it was also the safety net, for people thought that the institutions would be bailed out. I can't say for sure, but that made me a little bit more nervous. Current environment is one where risk pricing was never going to get this right for a pandemic crisis. This is a risk that has hit us that nobody was going to pay the insurance for this, year after year after year. It's like flood insurance down in, hurricane insurance down in Florida. It's extremely expensive, and all kinds of things like that. So I don't really worry about that in the current situation. I think it is very important that the programs that are undertaken are done with, a true sense of trust that, the funds are being put in the right place, but also verify, trust, but verify that they're effective programs, that, there's no favoritism, that it's very important that there's so much funding at work. It's really important that the public trust be maintained here so that we can continue to do as much as is necessary. Because if it's more difficult to contain the community spread of the virus, we might have to have remote policies for longer than anybody is expecting. And then if we're going to get through this successfully, that probably would mean more legislative help than what people are currently expecting. In that environment, I think that it has to be a trusting environment, and we have to be able to verify that that's done in the proper way. Certainly, the Fed is all about transparency and making sure that people understand why we're doing it and how we're doing it.
So one of the things we're seeing at the local government level is governors and states coordinating on supplying each other with resources where needed, trying to reallocate them to where they're most efficiently needed. As we think about, regional competition, if you will, or cross-country competition, and trying to open your businesses sooner than others, does the Fed view that it has a responsibility or a job to help coordinate a coordinated response as we start to open the economy?
I'm not aware of us having a coordinating role like that. What we do is we are in contact with, businesses, community groups around our districts, which with 12 districts, we span the entire country. We're always listening for what the problems are likely to be. These come in a variety of different ways. I happen to be on the board of a hospital, Rush University Medical College in Chicago. They actually have a specialty in dealing with epidemiological crises like this during the Ebola. And so, they've been front and center along with the other hospitals in Chicago at treating people who are COVID-19 positive and all of that. And, so I think it's important for us to take note of that, share that information with policymakers. It's a time for everybody to be doing that, for us to be working together so we can better assess and understand when the economy is able to get back up, on its feet. And it might be, a slow adjustment to get up there, but we have to do it in a safe fashion. And, it's going to take a national coordination with the states and everybody working together.
I think we have time for just one more question. One question is, what experience on a more personal level, what experiences in your life do you feel prepared you best to deal with the current situation, or possibly that when you started as president in 2007 with that crisis?
Yeah, that's a great question. When I became president in 2007, I thought that I was pretty well prepared. PhD in economics, Carnegie Mellon. I did a lot of research on monetary policy effectiveness. I was the research director. I had attended FOMC meetings with my predecessor, and I'd seen the response to 9/11 and others. I felt pretty well prepared. And then Lehman Brothers hit, and a lot of what I studied, what Ben Bernanke had learned in looking at the 30s was extraordinarily relevant, and so we sort of made it through that, but it was challenging the entire time. I think what's really important is knowing that you can work with people. Collaboration's unbelievably important. We get a large number of people together at each meeting, and groupthink would be really not productive if everybody thought exactly the same way. And so I've been challenged on a lot of the things that I was expecting from my own research in terms of neoclassical economics and, limits on what policy can do. And I think we just have to think bigger sometimes and take some chances. And so the lessons from the 12 years as being president and, thinking that, we need to go big whenever risk management calls for it, because usually going big when you do better than you thought, you can pull back easier than when you don't do as much as you should have done, and then you're behind the eight ball for a longer period of time. And so I think that's served everybody pretty well. I think Jay Powell has done a terrific job, having observed working with Bernanke and Yellen, and following through with the programs that we already had in place in 2008, and then innovating on the new ones like the Main Street Lending Program. The administration and Congress have been very helpful, working with the Treasury Secretary to make sure that we've got adequate funding so that we can be involved in the true spirit of the Federal Reserve Act, not overstepping our authorities. And so I think that's been very important. And those are some of the lessons that I've taken.
Great. Thank you for those thoughts. I'll turn it over to Chris now again.
Thanks.
Thank you, Ariel. Thanks for synthesizing the questions. I looked at the group chat, the Zoom group chat. We were having very large volume of questions coming through from many of the people. We've had 200 people in this Zoom session today. And you did a great job, Ariel, of pulling them together. And the answers were absolutely fascinating. I think I want to thank you very much, Charlie, for joining us, for joining the CMU community today, and for sharing your insights. This is the first online Zoom WL Mellon event that we've held. I couldn't imagine having somebody better for this event, who was so connected with policy making at such a critical time, and we really do appreciate the time that you've given us today.
Thank you so much. It's really been an extraordinary event. I've really enjoyed it a lot. So we're off to a good start. That's great.